I'm really pleased to be joined today by Dr. Richard Mattison. In July of this year, Richard was appointed as president of S&P Global's Sustainable1, a centralized group that represents S&P Global's integrated sustainability offerings and has a dedicated team that focuses on key ESG and climate topics. So, Richard, thank you so much for joining us today, and we're really excited to hear your insights.
My pleasure to be here.
Well, let's just jump right into it. So I was listening to Mark Carney on a Washington Post live event, and he was talking about the fact that we will need, quote, money and a lot of it. He talked about the need for investment in the range of 100 to 150 trillion over the next 3 decades. So in your view, what can be done to support a large-scale reallocation of investment into sustainability initiatives?
Yeah, that's a great question. I mean, from our perspective at S&P Global, we believe that you can't make investment decisions without having the right level of quality and confidence in data and information that you're using. And so one of the key parts that we need to get right up front is ensuring that when we allocate capital, we're doing so with confidence that we are driving real world outcomes and that the data, if you like, is credible and robust. And I think that is still a challenge. We certainly have enough to get going. There's plenty of information swirling around the system right now. The world's largest companies are now fairly reliably reporting on a number of different sustainability topics, but we do have more of a direction to travel on that. So, for example, last year we had to, we look at the climate reporting for of companies of the world's 15,000 largest companies on a routine basis, and we had to cleanse about 2,200 climate disclosures from companies because, for a number of different reasons, they maybe weren't consistent with global standards, they were limited in scope, whatever. But I think the point is that really, if we're to allocate capital carefully, we need to ensure that the information being used is investment grade, is reliable, is of audit quality, is consistent and comparable, all of those things. And so that is step one, I think, of the building blocks you need to allocate capital. Then after that, we are actually seeing significant demand for allocating capital. 50% of inflows to European ETFs was linked in some way to ESG. And so there's significant appetite for investment in this space. And that will only scale over time. And we're confident that will happen with the right data sets and the right incentives.
Maybe another really complex topic, and it's going to be critical, I think, is this, everyone's out there putting their commitments forward and all these great things that they're doing. But we've seen this issue of greenwashing, right, where perhaps a product, a service, or a strategy is exaggerated or misrepresented in terms of the climate or decarbonization benefits that it provides. And we've seen quite a few call outs in the media to that effect. With S&P's unique position, you've got all this data and this insight across the corporate landscape. Again, your view, what can we do to prevent businesses and indeed countries and territories greenwashing, which will only set us that much further back, right, in making the real progress that has to happen?
So, I mean, I think this is a really interesting point. I mean, as we see large-scale capital allocation, we need to ensure that the mechanisms by which we track how that capital is being allocated are of a professional grade. And if you think about this whole industry of climate analysis has grown up really from nowhere to being something that is very important today. And so we need to continue to invest in this space to ensure that we aren't allowing greenwashing, and also that the regulators, which they are actually acutely aware of some of the issues. So, I mean, from our perspective, yes, this is an issue. Sometimes it's intentional, perhaps, hard to prove that. Often it's unintentional. Often it's funds that are using certain types of information, and by proxy, they may be saying, well, if I'm actually de-risking my portfolio from climate risk, then surely I can call it a climate fund. Well, actually, the critical thing here is around definition. You can actually de-risk your portfolio from climate risk in the future. But when you look at that fund, is it actually reducing emissions in the real world today? Well, perhaps not. You might be taking a risk lens, not an impact lens. And so I think we need to be clear about definitions And I think it probably is something that regulators are really looking at very carefully right now. And there is an SEC probe underway into a number of different firms right now. So I think one of the things that may be useful is that the typical type of information you expect to see reported on funds from a financial standpoint that has been highly regulated to avoid any misclaim, if you like, of success or risk or otherwise. And we probably need the same level of rigor around climate reporting for funds in particular. So maybe we need a standard set of metrics with key definitions that are agreed upon, and those set of metrics will actually illustrate the extent to which a fund is either reducing risk in some way that might be very useful, either today or in the future, or creating some positive impact, some real world reduction in emissions. And so I think without making this overly complicated, perhaps a dashboard, if you like, of metrics might be useful for funds to be thinking about reporting on to those readers of that information and users of that information in order to avoid claims of greenwashing. So greater transparency, I think, is going to be required. We do have a lot of data. It's getting better all the time. I think now what we need to do is ensure that that data is deployed to allocate capital, and that everyone is transparent about how that is done.
Yeah, that's great. And I guess certainly in the EU, I think they're reasonably far down that path, right, in terms of those kind of fund disclosures. So it'll be interesting to see what develops perhaps here in the US, for example. Because certainly global investors, global problem. That's one of the huge challenges. Is it's hard for one jurisdiction to get ahead while others maybe haven't yet moved forward in the same manner. So, well, you've talked a lot about data, and I wouldn't be doing my job, I don't think, if I'm talking to S&P Global and asking, on that topic of data and insights. Like, what do you see as the big emerging trends or issues, if you will, in terms of what you're focusing on and helping organizations to understand climate risk, and anything else you kind of haven't already hit on?
In terms of some of the trends that we see, one of the big ones that we're examining very closely right now is carbon pricing. Carbon pricing comes in many shapes and forms. So it can be carbon taxes, carbon trading, carbon offsetting even. And in fact, 25% of the world's carbon emissions are actually already priced in some way in 45 different jurisdictions. So it is kind of here. It's probably here to stay. And what will be interesting is to see how it ramps up. At the moment, we're sitting at an average carbon price outside of an energy crisis, an average carbon price that would be between $10 and $20 a ton. And really that according to the OECD would need to be more like, $120, $130 a ton by 2030. So carbon pricing, big topic, potentially big risks. We monitor that very carefully. For the top 1,200 companies in the world, the S&P 1200, we would say that carbon pricing could have an impact of as much as 13% of profitability by 2025 in a strong policy environment on carbon pricing. So that's one that we're examining very closely. The other is net zero. That we need to be on a net zero trajectory for us to achieve our climate ambitions. Over 4,000 companies have now made some kind of net zero commitment, including ourselves. And of note is the Glasgow Financial Alliance for Net Zero, which is a collection of asset managers, banks, insurance companies, pension funds, and many others, all of whom have signed up to net zero, and collectively they manage close to 100 trillion of assets under management. So, when people talk about the trillions required for climate transition, we have 100 trillion already committed to that climate transition. So we are really monitoring that very carefully. I think a couple of other areas would be, the integration of climate change in materiality considerations and how that will shape out. How do you assess the financial materiality of climate change over a short and long-term trajectory? And we're thinking about that also in the context of how we're integrating climate change in credit ratings and credit scoring and a number of other areas. And then the final point I'd say is the intersection between biodiversity and nature risk with climate. So we have a lot of net zero commitments. It's fantastic. But the challenge is some would assume that if we decarbonize energy, how we produce energy, and if we decarbonize mobility, how we move around the planet, then actually we've solved the climate problem by and large. And those are two major things to do, obviously, that require enormous amounts of collaboration and capital. But the truth is, if those are the only two sectors that we focus on, we will create a lot of other risks through our consumption, and we will actually create large-scale deforestation, large-scale impacts on marine ecosystems and various other habitats. So I think, and we're already seeing that, and so. And some of those areas, such as large-scale deforestation, will actually reverse us on our climate goals. So in other words, we cannot singularly pursue sort of man-made approaches to addressing climate change through energy and mobility whilst ignoring how consumption is driving the destruction of natural habitats across the world if we're to achieve our climate goals. So really what we need to be is net zero for climate and net positive for nature.
Yeah, that's great. And you're right. You can't, if you focus too much on one piece of the puzzle, you're going to be over-indexed and probably create a more acute problem somewhere else. I did want to just go back to this idea of carbon pricing. It's incredibly hot topic, super interesting. You work with a ton of clients. I know you can't get into specifics, but have you seen maybe an organization that's done something really different after they adopted carbon pricing? Did it dramatically change any strategies or things? Anything you could share there?
What we tend to find is companies that set themselves internal carbon pricing mechanisms, and the last count, I think there were 1,500 companies that were doing that at least, tend to do a number of other things at the same time. So they start to link climate progress with compensation. They tend to think about capital allocation in a different way, because often internal carbon prices are actually linked, they're within the budget context. And they tend to be clearer on how they report out on their goals. So how are they going to get to net zero, and what are the milestones to get there? And they tend to also have a much clearer position on the use of voluntary carbon markets, largely because they will really have gone through the process of, kicking the tires on how do you get to net zero? How do you ensure that the company isn't going to be paying too much for carbon emissions at some point in time, for example? So I think there are a number of, it's interesting, internal carbon pricing policies drive a huge number of different behaviors. And that has not gone unnoticed by the investor community in particular. So yeah, I think, and there are a number of examples, big technology companies being very transparent around how they're going to get to net zero, how they are actually going to deploy capital directly for their own businesses to reduce emissions, but also how and when they're going to start participating in carbon markets. I think there are a number of companies that have been very transparent about that, in particular some of the bigger technology companies. What's one thing that you would advise business to do today to tackle climate change? I think vision is really important. So I think, establishing a net zero goal, but, and this is quite a big caveat, that net zero goal should come with a really clear investigation of what is required to do by 2025. Because the scale and nature, we believe that the scale and nature of business transformation required to achieve net zero is still not being fully planned out enough, certainly from the perspective of looking at public reporting. And so it's what happens between now and 2025 and 2025 and 30 that's critical, rather than what happens in 2050, which will follow. 2050 commitment is great, but so we think net zero commitment on climate for businesses is critical, but really it's actually about a 2025 net zero commitment. That's the part that's critical. And so, when we look at the trajectory and the credibility of the trajectory, there is still a gap. There's a gap in the integrity of climate planning. We have the destination plotted in the GPS, but we don't have the route map. And so I think it's that I think that is critical, is the the exact plans around how you're going to get to 2025, 2030, those critical milestones. That is the one thing I would say that is important to galvanize, the strategy, the people behind, the transition to a low carbon economy.
Well, Richard, thank you so much for your time today. It was great, and just for sharing all those great perspectives.
Yeah, thanks, Rob. It's been an absolute pleasure. Thank you so much.